presentation contains current opinions of Moe Sansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compact Market Wrap YouTube update for January the 13th, 2025. I'm Mo Ansari, President of Compact Asset Management and the Chief Investment Officer. But first of all, before I start talking about the markets, I want to let you know our thoughts and prayers are with all of you that have been affected by the fires in Los Angeles. I know a lot of you have called us from all over the country. Mo, are you okay? How's Compact? Are you okay? Yes, we are fortunate. We're about 60, 70 miles south of Los Angeles proper, so obviously it's been windy here, but we're not affected by the fires. But there are a lot of people who are absolutely devastated. And folks, whatever anybody, all of you can do to help, please do so. I think all of the people would appreciate it. And our thoughts and prayers and whatever we can do, we're trying to do and help anybody in Los Angeles that have been affected by the wildfires. It's a terrible, terrible situation. I know a tremendous amount of people. Obviously, we have clients there that we've talked to, so we're doing whatever we can, and it's just a terrible situation. A lot of people that have been affected directly, a lot of people that have been evacuated, a lot of people that are on warnings. So it's just a tremendous situation. It's a very sad situation. I know you're talking about who can we blame and all of that. That's something later. What we have to figure out is how to take care of the people that are affected. Make sure you subscribe to this channel. Click on that subscribe button so whenever I do an update, you will be notified and you can go from there. Looking at the last week, market down 1.91% for the S&P. The Russell down even more, 3.5%. The NASDAQ down 2 1/3. And so all of the markets were lower. Why? We got the unemployment data came out much better than expected. That means the economy is doing much better than expected. That means the Fed does not have to lower interest rates. That took away some of the concern, some of the frothiness in the market. Everybody's expecting 4 interest rate cuts. The Fed said, hold on, economy is doing okay. We'll have to wait and see. And I think it's also the anxiety of a little bit of nervousness. What is the new administration going to do? What tariffs are going to get? What budgets are we going to get? What taxation are we going to get? And until we get that settled, I think we're going to see some more anxiety in the market. Energy was the best sector last week. Again, I think new sanctions being placed on Russia. Also some more anxiety over what's going on in the Middle East. Real estate, the worst sector last week. Again, with interest rates going up as much as they did last week, and there was a big jump in rates because of the economy doing better than expected. We saw the oil market up, but we saw rates go from 4.6 to 4.77. That's higher than the 4.73 that I've talked about was the last year's high. So we're above that, and now we have to look at the October 2023 high, which was just about 5%. We're pushing 4.8 today, so we're close to that 5%. Get above 5, then the market could really start getting hurt. But I think we're going to see this market sort of bounce around here until we get clarity on inflation, which we do get more inflation numbers this week. CPI, PPI coming out this week. And we'll have to wait and see how that comes out. Then we've got the inauguration. Then we'll see what the policies start looking like. Once we get that, the first 5 days of January were good. That's how they say January goes, and how goes January goes the rest of the year. So now we were negative at the end of last week. Looking at the markets, we were down. But if you look at the treasuries, they were down 0.87, while high yield was down only down 0.28. If usually high yield bonds go down more if there's a concern about a recession, that companies will not be able to pay their bonds. Those are high yield bonds, and that's when those rates. But the high yield market was not down as much. That means there's not a fear for recession. It's fear that the economy is doing much better than expected, and that could bring inflation back, that the deficits could go up, the tariffs could cause inflation. So that's the anxiety we're seeing in the markets right now. Again, we get inflation is expected CPI down from the previous or about the same at a 0.13 or 0.3 is what is last month it was 0.3. The PPI is expected to go up from 0.2 to 0.4, so that could be a little bit hotter than expected. So we'll have to wait and see how the inflation numbers come out and then how the new policies come out. Looking at the technicals, we're below the 50-day, that's the blue line right here, 59.33. We are below the 20-day, which is 59.52. So we're below all of these numbers right now. So we'll have to wait and see. Oh, these should be reversed. This is 52 and this is 59.33. Looking at the weekly charts, this is critical. You can see that this was the October 2023 low. That's the low we made in 2023 of October. That's the low right there. This is the 20-week moving average. We got below it. And that's where, then since then we came and tested it right here in April, May. Then we saw the market come down below it in September and October of last year. But then the green means we closed back above the 20-week. We went below it, closed back above it. Here we tested it again. Here we are testing it. We are below the 20-week moving average, but that is at 58.46. We closed at 58.36 today. Made a new low for this month. Got below the December, not quite below the December low, which is around 5,700. So we could go and test that, the October of last year's low, but we'll have to wait and see. We did make a new low below last month's low. So if we can get above and close above 46, that would be very good this week. And that's what I'd like to see, is a close above the 20-week moving average. We got here, scared a lot of people out of the market. This was in July and August of last year, and came right back up. And from there, we were what, about 5,000 or 5,100 right here. We went from there to 6,100 up here. So that was a big move, but it scared a lot of people out of the market. Again, we're down about 5%. That's a normal pullback in the market we're seeing. NASDAQ below that, but looking at the weekly charts on the NASDAQ, 18.8 is the 20-week moving average right here. We closed at 19. We went down to 18.8, bounced right off of it, closing at about 19.1 today. So we're right back above the 20-week moving average. But NASDAQ gets more volatile. We'll have to wait and see how that works out. 10-year yield, this is the high that we made in October of 2023, 5%. That's where the high was. We're at 4.997 was the high. Today we're at 4.8 is where we are. So we're about 20 basis points, a little bit more room to the upside. We could see the spike, but we've got the Fed meeting at the end of this month. So we'll have to wait and see. The Fed might not say, we're not lowering interest rates, but we're just a little bit loosening the screws on the money supply, where we're going to do tightening, quantitative tightening. We're going to do less of that, and that could be positive for the market. Small caps are right at the 50-week moving average right here, 213. We got as low today as 213.97, closing at 216 or so. This is, if interest rates are going to turn down from here, I think the small caps could rally. But before we get above 245, which is this high that we made nearly 3 years ago, we've got to get above that. We came and tested it right here, but we could not break it. Though that's right, same as this high right here. So we got to break above 245 to really set that we made a low in the small caps. Crude oil is going up, broke above the 200-day moving average. Resistance now is about $80 a barrel. That was the high that we made here. So we'll see. We are about $78, $79 a barrel today. Gold market down big today after it went up last week, down to about 2,600 or so. So we'll have to wait to see how gold, I think, is just stuck in this range between 2,800 on the top and about 2,500 on the bottom, and just going back and forth, back and forth, back and forth is what we're going to see. Those are my thoughts. Those are my observations. Again, if you need help, if you're nervous with your portfolio, if you're losing sleep over it, give us a call. We'll be more than happy to help get you situated in the right risk profile that you should have so you can handle the volatility in the market. If you want some opportunities that you see in the market right now, you you want to participate in those, give us a call, 800-388-9700. Just go to our website or email us at invest@compact.com. I will be back with you at the same time next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.